to Adrian Mowat, Chief Asian and Emerging Market Equity Strategist at JP Morgan. Adrian, hi, morning. Good to have you on the show as always. How much return do you expect from Indian stock markets in 2013?
Well, we don't have an official forecast for the Indian markets, but our expectation is that emerging market equities will give you a return in excess of 15%, and we think India will outperform emerging markets.
Adrian, what is your economic outlook in terms of interest rates, and how much easing do you expect in the whole of 2013?
We do expect cuts in the first quarter. We think there'll be a modest amount of easing by the Reserve Bank of India. But the other factor investors should look at is what's happening in external debt markets. There's a lot of enthusiasm for emerging market credit. And we think Indian companies will be borrowing more money abroad, and that will allow market interest rates to fall.
Adrian, for 2012, Indian markets, they pretty much ended at the top of the heap. Do you think for this year, Indian markets, they will continue to outperform regional markets, and especially the BRIC basket?
Absolutely. I think India remains one of the best picks in emerging markets. You're going to see a cyclical uptick. We expect industrial production to move from a very low level that it was experiencing in 2012. We have some monetary easing. We have a very competitive currency, a significantly better policy environment, and a market that looks interesting across nearly every sector, including IT. And we had some good numbers out of the Indian IT companies in the results season. So the only part of the Indian stock market that we're cautious on is expensive consumer staples. But the balance of the market looks very good. That's in contrast to China. The macro environment in China has definitely stabilized and improved, but the index composition is less attractive than India.
Adrian, so what, according to you, would be the drivers of the market? Will it be PE expansion or an EPS increase?
Well, I mean, the couple of things in the question there. There's the fundamentals. We do see strong earnings growth. Even with last year's economic problems, we got double-digit earnings growth out of India. Compare that with no earnings growth in emerging markets. So we're expecting high teens earnings growth out of India. We do expect PE multiple expansion. And so that's how you get to this good return. We think the fundamentals will attract flows from both international investors, so FIIs, as well as we expect domestic investors to turn from being net sellers to net buyers as interest rates fall in India and the local savers no longer have the option of high fixed deposit rates.
HCL Technologies is at 700 rupees. So it is building on that advantage. 701 means HCL Technologies in last 1 year has appreciated by a good solid 60% plus. In last 1 year, the index is up by about 25.5 to about 26%. But HCL Technologies has been a marked outperformer. Suzlon also not a bad start. 19.5, almost 20 rupees now for Suzlon. Unitech is at 39, and Tata Motors, it lost about 4% yesterday, but it has managed to regain half of that. It is at 326 rupees. Metals are not looking strong. So if you're trying to, identify pockets of weakness, I would say it is metals, some consumer durable stocks. For the first time in many days, the small cap index is outperforming the Sensex 30 and the Nifty 50 basket. Now, typically, you want to see that if we are in for some stable, days ahead, more than anything else, the market breadth has to stabilize. I don't think institutional investors are nervous, but there is definitely some edginess which is visible in local traders, because the profile of stocks which have cracked or which have turned volatile in the last 2 or 3 days, those are largely dictated and dominated by local traders. Suzlon, Unitech, to a large extent, I would say HDIL, and then Indiabull Twins. Adrian, so at the current juncture for 2013, to your mind, what are the key challenges Do you think government will deliver when it comes to reforms and when it comes to policy action?
So India still has a relatively high inflation rate. We think the degree of that is structural. It partly reflects very weak infrastructure. And what the government needs to do is sort of focus on trying to deal with these bottlenecks. And in order to do that, we need progress on the policy front, and we're absolutely seeing that progress. We have a very interesting situation where the Prime Minister is chairing the Investment Committee, which is reviewing the progress of major projects in India. And we think that this hands-on approach is going to allow India to be much more effective than it has been in the last couple of years in implementing these large projects. And so I see a place where people are very familiar with all the risks, with policy, with inflation, with slow growth. And in fact, most of those risks are actually diminishing in India. Now, if we look at an external risk, that would be the current account deficit, which has continued to expand. At the moment, I'm not too anxious about that risk because there's plenty of demand for EM fixed income. But if there was a change in the global bond market, then India would be vulnerable to that because of this large current account deficit.
Adrian, so which are the themes and sectors that you're bullish on right now, and which ones would you recommend staying away from currently?
Well, as I was saying earlier, buy the market with the exception of consumer staples. So it's a pretty simple story. We like nearly everything in the Indian market. But if we're going to specifically focus on a few things, continue to like the private sector banks. We like engineering and construction companies. They tend to be driven by improvements in order backlogs. And we're optimistic that you're going to see more orders for capital equipment in India as we go through 2013. We also continue to like building materials.